Another year of Sunday/Monday Night Futures Live. I was just about to say Sunday Night Futures Live. Um, we have a lot to go over getting ready for the new trading year. We are seeing equities pop up higher here in the pre-market session, up about spot 6-7%. We were higher, a little bit of a fade, but we're trading above the third standard deviation Bollinger Band on a 15-minute chart. So let it come in. Do we put in a higher low? Do we fill the gap? Do we proceed higher? We don't know. All we want to do is this. We want to take our crayon out. We want to draw our first alert of the trading year. The first tick of the trading year is an up one. Do we get a January effect? We will talk about it. Cool. I just want to know, do we put in a new higher high on the session? Now, let's take a quick peek at what else we're going to be talking about today. We're going to be talking about the market data coming out this week, economic data. We're going to be and there's a lot of it. Next 2 weeks, huge amounts of economic data. We're going to be talking about valuations. Are we expensive? Are we cheap going into the new trading year? We're going to be talking about the January effect. We're going to be talking about how we closed out the year on a historical basis, what normally happens after a down year. We're going to talk about that. We're going to talk about obstacles in the way of the market. We're going to talk about Michael Burry. We got so much to go over. But first, let's say hello to people that were kind enough to say hello. Trader Isaac. H&A Bob. Oh, Happy New Year to you, my friend. Are you looking at the weekly gold futures chart and predicting 5,000 like a friend of yours on Twitter? Who's that, Peter Schiff? I don't know about 5,000. Could be. I mean, it could be. I don't want to say no, but that's a pretty huge obstacle to get to. That's a big target, I should say, rather than the obstacle. We got to make new all-time highs first. We're not even above 1850 at this point, so I tend to doubt it, absent some sort of a calamity out there. And with the yield curve the way it's looking, which we're going to talk about as well, we are way too early in the cycle to be able to say 5,000. I'm not going to make that prediction, but I am going to go over a chart of gold in the back half of the show that is going to knock your socks off. It's so bullish. So I'm going to save that to the last. Tim, hope you're feeling good. I am. Thank you very much. Yeah, I got sick about a week ago. Still recovering from the hip surgery, but back in the gym, feeling really good. Did my first real workout this past Friday. Was 12 weeks since the surgery. I promised my surgeon and my physical therapist guy I'd wait till 12 weeks. I was back in there 2 days ago, and I'm in a lot of pain. I'm in a lot of pain. In fact, so much pain. But I got to wear a sling at night because my muscles around my shoulder, which are kind of weak, because I had shoulder surgery a number of years ago, they are giving me kind of a problem. But we'll get through it. We are strong. We are not woke. RL, Happy New Year. Franklin, hello all. Yeah, well, what Franklin is mentioning, folks, is that I put out the market strategy for 2023. Basically, what I did is I took a look at the monthly and weekly charts of the major averages, bond market, a few stocks, gold, etc. And I think it kind of lays out how we closed out the year. And I want to say bullish. We did not close bullish. We closed fairly bearish on the year, implying that we're probably going to see lower lows. And I don't want to give that message. I want to be the guy, the slick back salesman on CNBC that comes on and says all is well, because knowing going back 100 years, the Dow Jones is up 71, 75% of the time. That's an easy play. It's about probabilities. They can do that. We're not about probabilities. This is a very difficult market. We were bearish all year long, rightly so. And our strategy of swing trading stocks short term, building on gold mining stocks, silver mining stocks, that played out well as selling premiums, selling options. I don't see any reason to deviate from that strategy at this point in time, because the name of the game as it was in 2022 is going to be the L word. And L word could stand for loser if you're too overly weighted one equity. And don't get me wrong, I got my head knocked in because I was too overly weighted Netflix, not once, but twice during earnings. Once bitten, twice shy, and we stayed smaller throughout the remainder of the year. So I'm not coming on here pounding my chest saying I didn't learn my lessons last year. I did. I did. But we learned from them, we adjusted, and we moved forward, always moving forward, just like Rocky. So that's the game plan still for 2022 until we see a resolution. We're going to talk about resolutions in a moment. So E-minis opening up strong here. Let's finish off saying hello to people as they're so kind enough to drop a note. Pete, top of the evening to you. Happy New Year. Tom, Happy New Year to you, my friend. TF Adder, welcome, buddy. Gold 1850, then 1900, and that's the attitude that I think you really need to take, right? 1850 on weekly time frame, monthly time frame is pretty stiff resistance. We've been struggling to get through 1850 on gold for quite a while now, so that leads me to believe that the longer we stall at that resistance level, one of two things is going to happen. Either we get a resolution of a major gap up in above 1850, or we pull back. We get an orderly pullback. We get rid of the sellers, and then that sets the stage for another move up against 1850. And then, of course, yeah, you're talking about 1900. And then, of course, assumes no major event out there, a geopolitical event where the U.S. dollar can rally as a safe haven play along with gold. So let's continue on here. Nat gas, we're going to get to that in a moment. Nat gas has been very, very weak, especially in the back half of the year. So the E-minis, they are still up. They gave away some real estate here. They have bounced back some. Let's see how it all plays out. I suspect that we're going to consolidate a little bit and quite possibly see another run up higher before we log off this evening. Let's move on. Let's take a look at the NASDAQ, sticking with equities for a moment. NASDAQ, where are you? Oh, here, I'm on the wrong tab. Wrong tab, Bob. Okay, so the NASDAQ, which was clearly a laggard relative to the S&P 500 last year, has also gapped up. We were up probably easily 0.75 of a percentage point. We have faded here a little bit, but again, what we want to do is we want to identify the highs, and we want to know, hey, do we consolidate here, and do we break out to new higher highs? That's higher lows, higher highs. Taking a look at what do we want next? Let's go with the Russell right next door here. The Russell, really, really good. We had a bigger pullback off the highs, but we have since retraced and recaptured a lot of that lost real estate. We're up nearly a percentage point. And I'll be honest with you, the weekly and monthly charts of the Russell 2000, while they had a pretty good middle portion of the year, the final couple of months or final month was not that good. So I'm a little bit suspect of the Russell 2000 here. So I would not go chasing any rally in the Russell quite yet. But it's looking good right here, right now. Let's check out the Dow. The Dow closed down, 9% on the year last year. It fared much better than the S&P 500. And this is looking pretty good here. Dow futures are up over a 0.5 percentage point. So looking good. A strong open for equities. Now, let's take a quick peek at the VIX. This is I believe, the June contract. This is not the index. and we have a gap down here, as you might expect, on volatility. So if we open up weak tomorrow on the VIX and strong on equities, that means a lot of premium that we have sold, especially on Tesla, on other positions. Those options will become cheaper because volatility is getting taken out of the premium, and that's good for us. We like that. So we like to sell expensive options, and then as those premiums collapse due to time decay, due to a reversion to the mean on volatility, reducing the value of the option, we take those profits, raise capital, and we want liquidity. We want those capital reserves. Will Tesla weaken the market tomorrow? I don't know. I saw an article about their sales that came in disappointing. I believe it was released today, 940,000 vehicles. Is that priced in? I'm not quite sure. So I'm not a fundamental guy. I can't claim to have those answers. The markets are going to tell us tomorrow morning pretty early on. But I think that any weakness on Tesla is in all probability going to get bought. Keep in mind, Tesla, one of the first names that's going to be announcing earnings. There's probably going to be some buying in advance of earnings. That's what I suspect, especially if this rally in equities holds up for the next couple of weeks. Bonnie Bean, Happy New Year to you. Welcome. Pat, hey, Pat. Happy New Year, my friend. Okay, let's move on. Let's take a look at the US dollar. We'll talk a little bit about currencies. Why do we talk about currencies here? Because they matter. All right, they really, really matter. The QQQ stocks, Microsoft in particular, has been unashamed to say, hey, listen, this strong US dollar going back for the past couple of quarters is no bueno for our earnings. Since then, the dollar has come in some because the US dollar is not the only currency play in town any longer with a Federal Reserve or central bank that is raising rates. And we're looking at the dollar now. We are about flat relative to Friday's close. I'm surprised about this. There may be a lag in the open here. They may not have opened. Let's just set up an alert here. I want to see what happens. We're going to go to the euro yen in a moment. It's very strange that we're not seeing any price activity here on the dollar. All right, so our alerts are set. We'll get notified of when it opens up. It does not look like it's trading at current. Let's take a look at, we'll go first with the first one I see, either euro or yen. It's not on my list. Okay, so we'll go with euro. The euro is gapping down. That means we're going to see an open on the dollar, which is going to be stronger, absent of massive move up higher on the Japanese yen. So the euro is really moving lower, about just shy of a third of a percentage point. It's testing a support level. Now, keep in mind the euro has been very strong of late. What's the Japanese yen doing? Well, the Japanese yen is offsetting some of the losses of the euro relative to the dollar. And while the dollar will, in all probability, move up higher versus the euro, it's probably going to move lower versus the yen. Now, gold traders don't need to know what happens when you get a rallying dollar. You get weakness in precious metals, but that's not what we're seeing right now. We're seeing a rise in gold prices by nearly a half percentage point. We were measurably higher earlier, still well below the 1850 mark. I don't know whether or not gold is going to be able to rally through that 1850 mark with a rallying US dollar. I went over the dollar on the 2023 market forecast. I am not bullish on the dollar. I do think that we had lower from here. Any move up higher in the short term is probably going to get muted and we'll head lower. allowing for gold to move up higher. But gold, first tick up for the new year, it was an uptick. We like it. Let's take a look at silver. And then we'll go into agriculture, protein. Silver with a move higher here, but a reversal bar. Now, silver in 2022 vastly outperformed the S&P 500, and it outperformed gold. So if I had my druthers of which one I don't want to own right now, in all probability, I'd go with silver. Why? It's an outperformer. But right now, we have a potential filling of the gap here. We're still up nearly 3/4 of a percentage point, but a big reversal lower. We have been trading within a trading range, a widening trading range, and you can see we gapped up and it failed. We're probably going to fill this gap. We are filling it right here, right now. The question is, do we hold or does it break? You don't want to see it break trend. Right now, we're down below that support level, but this 15-minute bar has plenty of time to rally back and move up higher. Let's stick with the commodity trade for a moment. Let's take a look at nat gas. Wow, nat gas plummeting down. I have to think that this is a buying opportunity here. Down over 7.33%. In the back half of the year, we got stopped out of our nat gas trade. We were long of oil. We stopped out of that. Thank God we did. And we're looking to get back in. So I think on this weakness here, I have to just start thinking about putting on a long trade. We have a long trade on selling premium. We sold naked puts on natural gas oil, and we are those expire in February. So we're probably going to be looking to put on a new long trade here on what appears to be an absolute and utter bloodbath. And this is what we like to do. This is the contrarian in us. We like to find historical support levels on anything, natural gas in this case, and then we buy at that historical support level. And if we see a reversal and a close above that support level, then we look to add more, build on that position, because we want to buy when there's blood in the streets. So we are really weak here, amazingly weak. We are short of the XLE. That's the energy sector. Let's take a look at what light sweet crude is doing. Light sweet crude is up fractionally on the session. But I'll tell you, I looked at the chart earlier on oil, and it looked pretty good. I would like to say it looked bad, but I got to be honest, I can't speak my book here. The price of oil is putting in higher lows, higher highs, and we are poised to see a continuation breakout on the price of oil. Now, I'm going to go to an article in a moment about the price caps that the Europeans imposed on Russia, which is going to be another joke. But all it's going to do is increase it. All these caps are going to do is reduce supply. That's all it's going to do. And it's going to cause the price to go up through that 60 cap. So the West is just sealing its own doom. It's so sad. Gasoline prices, they're moving up higher. They have really picked up steam in the past couple of weeks. Let's take a quick peek at agriculture, corn first. Let's go to the weekly charts, as we don't track these all too much intra-week. Last week, another higher high. We're at resistance, but the trend is good here. Soybeans. This is last week's price action. We had a breakout last week on soybeans. A very nice move up higher. This is a breakout. Soybeans are moving up higher. Wheat prices looking very, very good. Again, this is last week's weekly chart, not an indication of how we're opening this week. and wheat prices are moving higher. So agriculture is moving up higher. Energy prices moving up higher. So while I want to be the bull, I want to be a bull. I want to say, listen, equities are opening up strong. But folks, if food and energy are pressing up higher, what does that mean for the consumer? It doesn't mean good things. It means bad things. So let's not get lured into a false sense of New Year's security. Let's appreciate what the markets are telling us. What is the market most afraid of? The market is most afraid of an aggressive Federal Reserve. End of statement. They're not even as concerned about the potential of a nuclear conflict in Eastern Europe as they are about the Federal Reserve. Think about how insane that is. That being said, do rising food and energy prices mean a less hawkish Fed? Absolutely not. It means a more hawkish Fed. So let's look at these data points, remember them, and let's not get lost on what the talking heads on CNBC want you to listen to. I'm gonna give you some hopium in a few minutes, but first we're gonna walk through a minefield of what's out there that could cause a problem. So they're going to give you the hopium on CNBC and Fox Business News every day, all day, so their advertisers are willing to pay more for more viewers. They want those eyeballs. They want you to drink up the hopium. We're not going to do that here. So like, subscribe, comment. Let's go to some comments. Sam, Happy New Year, my friend. Thank you for being here. COVID is everywhere. Hit us hard here. I'm sorry to hear that, Pat. Everybody's all right, though? Recovering well? Happy New Year, Dan. Thank you. TD Ameritrade accounts being phased into Schwab. Schwab's a good company. So is TD Ameritrade. I have both. Obviously, this is Thinkorswim. Wasn't NG in the twos for a long, long time? Yeah. I mean, for years, natural gas didn't move. Then it moved up, and then it crashed. Now it's moving back up again. Do you think it's a good time to long Canadian dollars and Australian dollars? I'm assuming that that's what you mean. And if that's what you mean, Canadian dollars and Australian dollars, yeah, as long as commodity prices and those names in particular, you want to look at in the Canadians' backyard. You want to look at oil, nat gas, gold to a certain extent, some precious metals, industrial metals. Australia, you want to look at the metals markets in particular, industrial metals to a lesser extent. You want to look at the precious metal markets, but let's take a look at copper. I mean, copper for Australia is a huge export item. I had it up here earlier. Here it is. So copper weekly time frame, it hasn't been doing much. So there's really nothing here that would say, okay, you know what? Get aggressive on Aussie dollars, probably more so on the Canadian dollar with rising oil prices. All right, so quick run through again. The NASDAQ is now retraced a good portion of those opening gains, and this is what I was kind of worried about. So we could be filling the gap here. I don't want to be a doom and gloomer. All right, please. I don't want to be doom and gloom. I have good things to talk about as well as bad things. Dollar still hasn't opened up yet. The VIX is picking up, but no new session highs, despite the fact that equities have put in new session lower lows. So I'm not going to worry too much yet about equity prices. Plus, this is thin volume. Asia hasn't opened up yet. So let's give everything time to digest. Okay, going into the new trading week. I know you guys just lost my screen. Bear with me while I fix the problem. And now it is fixed. Okay, so sip of water. Tomorrow being the full trading day of the new year. We have the beginning of a long round of economic data that is coming out. So for the next couple of weeks, it's going to be hot in terms of economic data. We're going to go through it all right now, so that way you're ready. Okay, get ready. Tomorrow, S&P Manufacturing PMI. That's the Purchasing Managers Index. Any read below 50 is a sign of contraction. Any read above is a sign of economic expansion. We have been below 50 on this read for several months now. We also get construction spending tomorrow. We're going to get the Institute for Supply Management Manufacturing Index. Again, same deal. Any read below 50, sign of contraction. Job openings, that comes on Wednesday. Jobs quits, that's what it sounds like, how many people are quitting their jobs. We're going to get the FOMC minutes. That's always a market mover. Thursday, we get the precursor to, this used to be released on a Wednesday. Now they do it on Thursdays. Interesting. Maybe just because of the abbreviated week. The ADP report is coming out. This is the new and improved version of the ADP report. On late Thursday morning, we're going to get the S&P US Services PMI. That was above 50, signaling expansion for a while after manufacturing went negative. But this is the final read for, I believe, last month, where we saw a contraction in services. Now, here's where we pause, right? You're going to hear, and I read it constantly as I prepare for the show, economists believe that we're going into recession. Okay? Give me a break. We have been in recession since Q2 of 2022. I repeat, we have been in recession since Q2 of 2022. 2 back-to-back quarters of negative GDP is the textbook historical definition of recession until, of course, the federal government had an election coming up this time around, and they had to change the definition. And all the talking heads went along with it because they didn't want to be canceled. Valuations. Oh, I skipped. We have on Friday, non-farm pay, huge number. Remember, there's going to be a lot of expectation built into this report that it's going to be a negative read. A lot of economists have been out there, pundits have been out there saying that this year is going to be a jobs recession and an earnings recession. So they're expecting a very negative report coming out early in January. We're seeing it on the tech front already. Does it follow through to the rest of the economy? We will learn very, very soon. Also, let's keep in mind that we're going to have a Fed meeting beginning on January the 31st, ending on February the 1st. That's the first announcement for 2023. Valuations. We closed out the year pretty much near the lows of the year on the Schiller PE ratio, and we're still well above the historical mean at 16.99. Now, you're going to see pundits come out there and they're going to show you this is a trap, a value trap. They're going to show you charts of multiples, PE multiples on a forward-looking basis, and they're going to say, look at where we are. We're at historical lows. What they're not telling you is that the analysts of those companies, they have yet to ratchet down their expectations for 2023, in particular for the consumer discretionary stocks. So don't let them take parking space up in your head. Understand if they're talking forward PE, it's going to look like a chart saying, I got to buy stocks right now. Remember this commentary. You got to wait for the analysts to revise down their guidance, and it probably won't happen until after earnings. So please, don't get suckered in. Don't let them take parking space up in your head. Focus on historical, the 3-month moving average for, I should say 3 months, the trailing average for Schiller PE ratio. And if you're taking a look at the Buffett indicator, they finally revised this nicely. We are quote unquote fairly valued. That's misleading, because as of their note on December the 31st, we are still extended 23% higher than the long-term trend. This has a lot further to drop to be even on par with historical trend. And you don't even want to start buying stocks until we're below that historical trend. That means that the markets have dumped, people have capitulated. Then you want to go stepping in and using that liquidity that you've been saving all this time and putting it to work. And you're going to be putting it to work on days where the pits of hell have opened up and you feel sick with pressing the buy button. It's okay. Average in, average in. There's going to be a time this coming year where there's going to be great, great opportunities that present themselves, but you need to wait for certain things to get resolved. We're going to talk about them in a few minutes, so stick around. The January effect. Will there be a January effect for the overall stock market? We're going to be using TrendSpider and their seasonality tool to first walk us through historical performance of the S&P 500 going back. Let's go back even further. This is 12 years. January is basically a 50-50 month going back 12 years. Let's go back as far as possible. This brings us back to 1993, and it's a toying cost. January is a toying cost, and that's consistent with other charts I'm going to be bringing up in a moment. So I agree with this, fairly accurate. Let's take a look at the weekly chart of seasonality to see how I'm so used to looking at the right side, I have to get used to looking at the left side again. The first week of January is, for the past 19 years, is up 61%. The second week is up 67%. And then we tank. The third week of January is on par with one of the worst weeks out of the year. So keep that in the back of your mind. If we get this rally up and into that second week, don't be a chaser into that rally. While the probabilities are good for the first couple of weeks, we want to keep an eye on the back half of the month. That's when things get real fast. And what happens after that? Well, you have the Fed meet. The Fed's first meeting is already in the rearview mirror. The markets have reacted, and then you get your pop-up higher. So mid to late February appears to be good seasonality for a couple of weeks anyway. These are only for short-term trading scenarios only, not for investing at all. Use the monthly charts if you're looking for investments, not weekly charts of seasonality. Okay, January effect. We never got a real Santa Claus rally, and let's go with the January barometer. Positive reads over the past X odd years, 60% higher. Negative reads 40% in January. When you get a positive January, the S&P 500 change over the year is 15.9% up. Okay. If you get a negative read, you get a 8% decrease on the year. Not too bad. I'm not going to go over all three because we didn't get a Santa Claus rally. Up in January and February, it only happens 37% of the times. Think about that. And 24% of the times, that doesn't seem to add up, but okay, let's go with it. Oh, I see. Yeah. Okay, I understand it now. Took me a second. I had a senior moment there. Even though I'm not a senior, I am not a senior. S&P 500 change when you get January and February up, over 20% increase. When you get them negative back-to-back, down 4.4%. So, interesting data. Now, I keep hearkening today on your talking heads on CNBC. I can tell you that, if I'm right on a call, I don't necessarily put together a video and put it out there. I was right here. I admit it. I've done it, especially when it's a call like with Tesla. Nobody wanted Tesla. Nobody wanted Tesla a couple of days ago. We were in Tesla. We made money on Tesla. So I didn't put together, actually, I did put together a video. But keep in mind that these Wall Street banks, they always swing for the fence. They want to be the guy the following year. They put out the forecast for the next year, and they say they want to be able to come out the year later and say, look what I did. I hit my price target. Or they want to be invited on CNBC and they say, you know what? You were so right the year before on your price target. What's your expectation for next year? All right. So it's like they're building their clout on social media. So let's take a walkthrough of what they really knew at the beginning of 2022 and what the real read was. What was the outcome for their predictions? BMO Capital Markets. Remember, these guys are going to be all over CNBC the next few days, next few weeks. They're going to be giving their price targets, year-end price targets. Okay, how right were they last year? BMO Capital Markets, 5,300. I would call that a miss. What is that, a 30% move higher from where we closed out they need to get to? Wells Fargo, 5,100 to 5,300. Goldman Sachs, 5,100. JP Morgan, 50. RBC Capital Markets, they must have been comparing notes, 50-50 as well. UBS, 48.50. Bank of America, 4,600. Morgan Stanley, 4,400. Every single one of them wrong. And not just by a little bit, by a mile. So again, these guys come on TV in the next couple of days and you're watching and listening because they're the experts. They have the $5,000 suits. They got the slick back hair. They're wrong. They're constantly wrong. All right, so this is as quoted out by Wall Street Silver. Follow this guy on Twitter. He puts out some good work. I don't know him, but he puts out some good stuff. This is from Michael Burry. Inflation peaked. This is his call, but it is not the last peak of this cycle. We are likely to see CPI lower. Agreed. Possibly negative in second half. I don't agree with that. And the U.S. in recession by any definition. I agree. We're already in recession. Obviously, Fed will cut and government will stimulate. No doubt about it. Yes, that is coming. And we will have another inflation spike. Yes, agreed. So I mostly agree with him. I get where he's coming from. But the recession thing drives me crazy. We're already in recession. So what Wall Street Silver put some brackets about what it meant here. 1974 recession reduced CPI from 11% to negative 5%. Excuse me, from 11% to 5% by 1976. The Fed declared victory, as they always do. They never say they're wrong. The Fed declared victory, went back to easy money, and inflation soared into the late 70s to over 13%. High inflation continued until energy policy was fixed. We have no energy policy, folks. When you have a president, our current president, whether you like him, dislike him, I'll talk about his policy. His policy of going over to Saudi Arabia and begging hand in fist, whatever that, hat in hand, or going down to Argentina, or was it Venezuela, and begging Maduro to pump more oil is not a sign of a strong country, especially when we have enough here to supply all that we could ever want. So we have no energy policy right now. It is broken. And that's the problem that I see. And I mentioned this earlier, equity prices this evening going up higher, yet oil prices are moving up as well. That's a problem, along with food prices. Now, just how bad was 2020? Well, this is put out by the Financial Times. And you're going to hear, again, this goes back to my bashing ad nauseum of the Wall Street houses that think they know it all. And they have been touting. They want assets under management. They don't pick your stocks. All they do is they go out and they buy the S&P 500 individual names, and they give you a 60-40 split on what your allocation is going to be. 60% stocks, 40% bonds. That's all they do. Then they get their fees. So how did we do? How did that allocation do last year? By far the largest outlier of worst performance in history was that strategy in 2022. Did they ever offer to reimburse your fees, your money managers? I bet not. Okay, the final tale of the tapes, 13 most striking facts of 2022. S&P 500 fell by 19%, including dividends. The total return was negative 18%. This ranks in the fifth percentile of all annual returns since 1962. The largest S&P peak to trough drawdown during this year was 25%, almost two times the median historical annual drawdown. The odd part there is that the VIX had diverged with the market for the latter part of the year, but I digress. The market traded higher on just 43% of the days in 2022, the second worst year since World War II. This is interesting. The median gain on those days was 152 basis points, the highest in post-war history. So, what do you take away from that? You got to take away from that the value of technical analysis, because all you need to do is do this, right? You pull up your chart. Here's your downtrend line. Those rallies came off of a retest of the lower band of support. Watch your chart. It's all it's telling you to do. Watch the lower band of support. You tap that lower band of support, you buy equities, and then you enjoy the rally up higher, but you got to know when to get out. It's up here at the upper band of resistance. This is not rocket science. So if you're out of the market when we hit the lower band of support, you lost out on a lot of those gains. The Nasdaq returned negative 32%, lagging the S&P by 14 percentage points, registering the worst year of underperformance since 2002. I was in the market 2000 to 2002. That was a bloodbath. U.S. Treasury 10-year notes returned negative 16%, the worst record return on record. Why? We got 30 trillion in debt. Sorry if I'm screaming. Only two of the GIS, I guess that's sectors. Only the two of the level one sectors generated positive returns. Energy, yes. Energy was the number one by far leader. Utilities, you have certain charts that show them as down. It depends upon what benchmark you use. They show them as up 2%. I'll go with this. Worst sectors, communication services, consumer discretionary, annihilated. Infotech, annihilated. Best global markets. Keep in mind here, in local FX currency returns, all these countries, Venezuela, Turkey, Argentina, have massive inflation, massive inflation. So in their local currency returns, their stock markets did very, very well. In dollar terms, the worst, Russia, we took a hit there because they froze the Russian assets. South Korea and China, of course. Avoid China, folks. All right, so one of the major problems that we're going to have, and I mentioned this already with the price of oil, is that in the infinite wisdom of the West, which we continue to see is just being blind men walking around without a cane, and that's no offense to blind men. The European Union's ban on Russian oil products set to come into force on February the 5th. They haven't been importing oil in a while. Could lead to a 1 million barrel per day drop in Russian crude oil output for the new year. Moscow has warned it could cut production by 700,000 barrels per day as it responds to the $60 barrel price cap on its oil implemented by the G7 in December. Now, what they like to use is they have a dominance, especially London has a dominance over insuring those vessels. And they own those vessels. While Russia has their own fleet, you need more than Russia's fleet to transport that oil. And if they refuse to insure ships carrying Russian oil, well, that's what they believe to be their lock. But as the world is showing, the BRIC nations are coming up with their own economies. They're diverging, and this too shall pass. This is ridiculous. All it's going to do is increase the price of oil, especially as China opens up. Asia is where 90% of oil goes from Russia. End of statement. So this is really a nothing burger. The only problem it could cause us is that overall, less production in Russia means higher prices by oil. You don't think that the energy sector, light sweet crude, Brent, is not going to go up along with are Russian energy prices? They sure as heck are. So this is not good for the consumer. Long story short, it's again government touching. Whatever government touches, it screws up, and they're going to do it again. Price caps do not work. You cut production, prices still go up. If you're not going to get paid for your product, you're not going to produce it. All right. This is kind of a negative outlook. We have some positive to go to. 2023 outlook. Bonds do not look good moving into the new trading year. Agreed. Bearish key reversal bar in the month of December. An ugly month. Yields rose. They look like they're going to go up higher. Check out my forecast posted on YouTube. It does not look good for bond yields moving into the new year. It looks like we're going to press up higher. The wealth effect on individuals and companies and governments will weigh on economies and markets. Agreed. This is going to be a problem. Add to that the fact that I think there's a chart here. Yes. This is a chart of personal savings as a percentage of disposable income. Folks, people are broke. They have no savings. This is apocalyptic. This is apocalyptic. Add to this the fact that banks, net percentile of domestic banks tightening standards, meaning they're tightening up on their loan standards. They want only high quality risk. And they usually do that prior to going into recession, like back here, 2001, back here during a recession, 2008. You want to go back further? We can go back further. Actually, that is max. 2020, they didn't see that one coming, and they cut rates. They tightened lending standards after the fact. Folks, we're above the zero line. Any read above zero, the hard deck, is a signal that they are tightening lending standards. So the banks are expecting a recession. I'm going to tell you again, we are already in recession. This is just validating. At some point in time, the St. Louis Fed will update this chart when the federal government says it's okay to say that we're in recession. What are they going to say to the St. Louis Fed? It's okay to say that we're in recession. It's when we're out of the recession. It's when the Fed is cutting. It's when the government is spending more money to get us out of the recession. They will let them say that we're out of recession or there was a recession when GDP is expanding due to what? More debt. And it's already begun. 1.7 trillion just got passed. And you may be thinking, and here's the consumer. This is the XOY, the consumer discretionary index, down 36.25%. Outside reversal bar the prior year. One of the strongest sectors for many, many years is now by far a laggard. I see no reason why we would not head lower this coming year. What other problems do we have out there? I'm not going to get wonky on this, but folks, if you don't know what the World Economic Forum is, learn who they are. Learn who this Bond villain is. His name is Klaus Schwab. It's not just him. He's a puppet. Kissinger, Bill Gates. Learn who these players are. Go to the World Economic Forum's website, scroll down, look at who their participants are. Every single major corporation in the S&P 500, for the most part, not everyone. I don't want to be hyperbolic. Many of your household names are partners with the World Economic Forum. They are no friend of yours. These are the people that say you will own nothing and be happy. They are smart. These are the puppet masters that control the politicians. These are the people that are controlling the narrative right now. And if something doesn't get resolved here really, really quick, really, really fast, we're going to go off of a cliff in this country. You really can't even recognize it anymore in many areas. So much so that in California, as of yesterday, and this is the policy of the Davos crowd, the World Economic Forum. They want to kill small business. Large trucks and buses made before 2010 now banned from California roadways like that. Who owns those trucks? The small business guy, the independent worker. They don't want independence. They want conglomerates. They want multinationals running everything. Your local delicatessen, they want them out. They want you eating McNuggets and Egg McMuffins. That's it. And bugs. Don't forget the bugs. Europe. This is out today. It's disturbing. Huge death toll after U.S. supplied, I guess these are missiles, leveled Russian barracks in Donetsk, possibly hundreds killed. The escalation of this war in Ukraine is only getting worse. Nobody wants to talk about peace. So the death toll continues to rise, and there will be blowback for this. Have no doubt. This is only going to get worse. And who's behind all of this? Look no further. The Davos crowd. They want this. Why don't they want Russia? Why don't they want China? Not that I love China. I can't stand China. They're nationalistic. These people do not want borders. They don't want national identity. They want globalism. I don't call them elitists. You got to get away from elitists. Everybody calls them the elite. They're not. They're parasites. These are parasites. They're sitting in your gut, eating you away. You got to acknowledge that they exist. They are not a conspiracy theory. This is reality. You got to call your congressmen, call your senators. So you do not want the U.S. digital dollar. That is the death knell. That is the nail in the coffin for freedom in this country. And it's already being tested. Lastly, on the bad news front, we have more crypto damage. It's about to unfold. This is Cameron Winklevoss of the Winklevoss twins. You'll remember them from a social network. They were suing Zuckerberg for him stealing their idea for Facebook. They are now big crypto players. $900 billion wrapped up with this other company who I never heard of, Genesis, whatever. And apparently their money for their clients, who's held by this company, is in La La Land. So Lord knows how this unfolds. So the FTX damage is continuing to ripple through the economy. Tomorrow, we have a new group of Republicans getting sworn into the House. McCarthy, who right now looks like he may not get the chairmanship, is going to get the chairmanship. They're just holding out for best terms, rightly so. I do not like Kevin McCarthy, but he is probably going to win. And if you think that the fact that the Republicans are taking over the House means much, don't get too carried away. It's still a uniparty rule. Kevin McCarthy is a uniparty member. He's a rhino Republican. And if you think it's any better in the House, look at our friend, Mitt Romney, who is I'm going to play this. Let me know if you can't hear it. That's horrible. Let me know if it's too low or I should just bail on this. I'm not going to play the whole thing. Here's Mitt Romney talking about his support for $1.7 trillion of not total budgetary spending, discretionary spending only. That is only 1/3 of the budget. Here's Mitt Romney, a so-called Republican, a fiscal conservative. Give me a break. There's no sound. Can you not hear that? All right, I'm going to bail on it. So basically, what he was just saying, was there really no sound? This is why I got rid of I canceled my subscription to this software. Um, Basically what he just said is that he didn't want to wait until the new house came in because the bill wouldn't have gotten past Congress, and that if we didn't sign off on it, it wouldn't have been passed. So it's better to pay more now rather than voting down discretionary spending. He just said that this is not Social Security that they just passed. This is not Medicare, Medicaid. This is not uh, money that's required by law that gets paid out. This was discretionary spending. It didn't shut down the government, maybe the national parks for a couple of weeks, but this did not have to get passed. What he didn't want was negotiation. And if you go through this later on, what he does is say, listen, here's what I like about it. And he talks about all the pork he brought home to Utah. So this video is meant for his constituents at home. The money he brought home to Utah is insane. I'll share this out. Listen to it at your own leisure. Okay. Where is my, I skipped over something. God darn it. All right. All right. So earlier on, I talked about, and if I go over here, we're going to go over some chart requests. So we'll go over if we have to. Um, Earlier, and I've been talking about this chart for quite a while. Earlier, I was talking about events need to get resolved, right? Before we can say, okay, we can go from purely, of not, well, not purely, but by and large, an option selling business. We can go from that neutral bias on the market in generating cash flow and getting back into heavily trading to the long side of this market. I can't do that right now. That can't happen right now because of what this chart is telling us. And what this chart is telling us is that we have a major problem here. And I've been warning for a long time about the inversion of the yield curve. I'm going to go over this for the folks that are out there that are new. You don't know what this is, or you need a reminder. The yield curve has predicted every single recession since 1955, except for one, which is almost a recession, 1965. Every single time, every single time. And equities can rally when you have an inverted yield curve. That means that short-dated maturities, 2 years in this case, 2 years versus 10 years, are paying more interest than the 10-year. That's not supposed to happen. That's an inefficient market. So something happened in the month of December that began an event. It began a process. And that process was the steepening of the yield curve. And I'm predicting that we have begun the countdown in December, beginning in January, of the steepening of the yield curve. The only problem that comes along with the steepening of the yield curve is that's when equities begin to really, really take a nosedive. So what we may have seen was a severe correction in 2022. Keep in mind that we have never seen the blow off on the volatility index. Let's take a quick peek at it. Because the volatility index quarterly time frame is screaming cup with handle. It's putting in higher lows and it's just stuck here, stuck at the 35 mark, and it has never, ever broken above a 40 handle in 2022. Why is that important? Well, since 2002, we have at a bare minimum seen a peak on the VIX prior to a new bull market of a read above 40. The high of the year was 38.94. Yes, 38.94 Q1 of last year. Prior to last week's peak, the high Prior to that was 85.47. That was the COVID sell-off. Prior to that, 89.53. That was the great financial crisis. All of these events required fiscal stimulus. They required huge cuts in interest rates. So what I believe the Federal Reserve has been doing all year long is preparing for the next round of rate cuts. So the average time, I did this math earlier, and this is only 4 events, so take it, it's thin data. But out of the 4 times that we have begun to steepen, on average, it takes about 7 months for us to reach a peak, usually at a minimum spot 0 to spot 20, before the equity markets begin to really roll over hard. Now, the low of that range was 1 month. So keep that in mind. The high of that range was 16 months, the average of the 4 being 7 months. So at any point in time between now and July, I'm predicting that we are going to have a major sell-off in this market, a capitulation sell-off on the market. The Federal Reserve will then in turn cut rates. Congress will spend more money, and nobody in the Rhino Republican Party is going to stop them. Yes, please, if you could please smash and hit that like button, I would appreciate it. Thank you, Franklin, for the reminder. Thank you very much. I'd like to see us hit over 5,000 subscribers this year. Bob Arch says Tesla missed. I saw that. Yeah, it was on Zero Hedge. But you got to wonder how much is that priced into Tesla shares already. So I'm not all that worried about it. And if it does pull back, it's all right. I have naked calls above, so it's going to offset any losses below. I'm not too worried about it. Okay, so just beware. This needs to get resolved before we can go back to if you're older than 35, you're up in your 40s, before you go back into dollar cost averaging, this needs to get resolved. If you're in your 20s, you know what, keep dollar cost averaging. This is going to be a blip on the screen to you. That's what I tell my son. All right, favorite chart going into the new year, by far. And before I leave this is not bad news, folks. This is not bad news. The fact that we're sitting here, we have about 50 people on a Monday night, a holiday weekend. We have the first trading day of the year coming up tomorrow. The fact that we are aware of history and what this means gives us the power to say, okay, I'm not going to listen to these guys. Where are the guys? Definitely not them. Who got it all wrong with their price. God darn it. You know what I mean. Those guys earlier from the brokerage. Here it is. I think I just lost it. All these guys here, RBC, UBS, Bank of America, all got it wrong. All got it wrong. Nobody is talking about the yield curve. Nobody's talking about what it means historically. Nobody's saying, hey, keep some cash. Keep some cash. Understand that this market is probably going to take a massive tumble. We have not seen VIX capitulate. We have not seen the markets capitulate. We still have a inverted yield curve that is now steepening. These have consequences. So if you remain liquid and if you're willing to short the market when this begins to unfold, this is going to be an awesome year. It's going to be an awesome year. I'm very confident about that because you know the fundamentals, the mechanics of this market, and they're not good. Favorite chart going into the new year, gold. And it's not this chart. This is a monthly chart of gold. Unlike the S&P 500, it finished off the year very strong, still down on the year marginally by a couple of points. Silver closed up on the year. But what's the favorite chart that I like the most? By far, the quarterly chart of gold. Folks, we broke out on a quarterly time frame. I remember talking about this, and I expected us to really blast off in 2022. What happened though? What happened? Why didn't gold blast off? The dollar went like this because Russia invaded Ukraine, as well as the US was the only G7 economy that was raising interest rates until the final quarter of 2022. That's no longer the case. The dollar is weak, it is broken. So if the dollar is weak, that bodes well for gold, which flashed a bullish key reversal on the quarter, and it appears as though it wants to fuel up higher. I think that Q1, there's a very strong probability that we're retesting 1900 on the price of gold. Let's do some chart requests. First, let's go to comments. Ronald McDaniel, the RNC head, is Romney's niece. Is that a fact? Oh my God. Yeah. Isn't there another woman running as well? Michael Lindell, I know of. I don't know who Harmeet Dillon is. Just like Mitch, getting bridge built in Kentucky and hosting Biden this week to celebrate. Hard to take. Is that a fact? Biden went to a bridge opening or something? I know he's going to. He's in the Virgin Islands. QQQ. Okay. Bob, yes, we went over that one. Buy bonds. I would avoid bonds right now. Avoid them. They need to bottom out. We may get a higher low. I'm not saying for the rest of the year, but short term, avoid bonds. 40. Thank you for that, Franklin, again. Sleepy Joe is going to continue to send money to Ukraine and ruin our economy. Yeah. Uniparty rule. This is why they need to go. July is the bottom, and gold is on its way to 2,500 as Fed cut. Yep. ET. All right, let's write some of these down. We got ET. Qs I kind of did already on the year ahead forecast. We'll go over it. We'll look at the daily time frame. We're going to be using TrendSpider. If you're not using TrendSpider, begin the year off right. Treat yourself to a gift. Get a 35% discount off the price of TrendSpider. Automated technical analysis. So please go check them out. Begin the year right with a new tool in your toolbox. Where did I put it? Here it is. We have DBA for Myro. And let's get to it. We only have a couple tonight, so that's good. Let's clean this up. Let's get the heat map off. Okay. All right. DBA. I'm liking DBA here. This is a monthly chart. This is a food ETF. Food ETF. We already went over the pre-market price action of agriculture. It is going up. They are going up. Corn, wheat, soybeans. And what's in this ETF? Corn, wheat, soybeans. So this wants to go up higher. We have resistance immediately above. You can see how we were stopped there a few months ago. We are bullish on this. I believe that DBA is going up higher. Weekly view, unfortunately, that's not going to bode well for equities with food prices going up higher. On a weekly view, we gapped up higher last week, only to reverse. I would wait for a new weekly higher high here on DBA. Let's go to a daily chart. You know what? I would do this. Looks like it's consolidating. If it breaks out above resistance, I'd be a buyer. And that's at around $20.26. QQQ. QQQ. Not a good chart. I mean, we're at support, but we saw very close to an outside reversal bar. And what we're seeing, and this is what I mentioned on the 2023 forecast, is that you're seeing a double top on RSI down below 50. This is not good. This is bad. Very, very bad. Weekly view, we held support. Might we get a rally up and into around 291? Sure, it's possible. Maybe they'll pump the market in advance of earnings. We rallied off the lows of the week last week, but we are eerily close to the October lows. Daily chart, there's nothing sexy about this. Nothing sexy at all. We have broken down below the lower band of support. I got to tell you, I'm bearish. I have to say I'm bearish. I don't want to be, but I am. Why did buying come into Apple last hour of trade on Friday? Could have been tax loss selling, sellers that was sold 30 days ago buying back on Friday. Um, I don't think it's a 20. I think honestly, I think Apple, let's go over it. I think Apple's a short, to be honest with you. Apple's got problems. When was the last product you saw Apple come out with? New generation of the iPhone. I mean, how long are they going to play this one out for? They haven't had a real true product introduction of any means since Steve Jobs died. Think about it. And you look at this chart at a monthly time frame, I'll be a shorter of Apple. If Apple rallies up and into 135 per share, I would short at that level because I think Apple's going a lot lower here. And here is your lower band of support. You could see how far that Apple could drop. It could drop all the way down to 107. And I think that that's probably what's going to happen. I think Apple's seen its its best days. It's behind it now. The weekly chart, I know this looks like spaghetti. Let's get some of this stuff off to clean it off. Why do I have my zigzags on? No, I don't want this. All right, there we go. That's better. So we have a breakdown below support. We have another support level which is being tested. I can't buy this stock. I mean, might it rally? Sure. But I think that any rally is to be shorted on Apple. I do not like it at all. Daily view. There's no here. There's nothing here to get excited about. ET, phone home. How many times you heard that one? Energy transfer. Why does a zigzag keep popping up here? I don't want that. Okay. So clearly we have broken down. I don't know this company per se. It says energy. Energy's been doing good, but let's go to the monthly chart. It had an okay year. Looks like it's consolidating. There's a bias to the upside here. Uh, it broke out nicely last week, or the week before last. Did a retest last week, so it's looking good on a weekly time frame. But you do have, as noted by the VWAP in yellow, resistance above. Here's the play. They close it above, let's call it 12.10 per share. I'd be okay with getting long. Ugh. Gee, Bob. Set it and forget it. Tom, Apple needs 110 to bottom out. Yeah, the bare minimum. Yeah, I agree. Use Oh, you like that short vehicle, huh? I got to check those out. I don't think I've typed it up at all. Uh, are we going to wake up to see a bottoming tail on NG? Big puke tonight. The 406. Maybe. Maybe. RMED. We're going to leave it off here. Tim, you're very welcome. RMED. This is ResMed. Oh, it's not ResMed. Ram Medical. I think biotechs are going to do. Wow, this is nice. Very tight Bollinger Bands here. This looks ripe for a Bollinger Band squeeze. We had one back here up and into the third standard deviation. Bollinger Band pulled back last month. We began to press up higher. I think this is moving up higher. This is a great chart. Good chart. Very nice. We broke out last week. Daily view. We broke out on a daily time frame. Very nice. RSI double bottom setup at that 50 mark. Bullish. I like this chart a lot. We'll leave it off with NWTN. You're welcome, Franklin. Have a great night, pal. NWTN, it's hard to make a call here. I mean, tight Bollingers. 50-50. I can't draw a conclusion here. Daily chart looks okay. When I don't know, all I do is I take my crayon out. I put on alert. If we break out, the market just gave me my answer. You get long. If we break down, avoid it. Set it and forget it. All right. Tom, I'm very crazy on Cala. I heard about this stock. It's all over the web. I'd be careful here. I think that stock just blew through the roof. Yeah, you got to be careful here. I haven't had to say this in a while, but this is not going to end well. So be very, very careful. You have RSI at 96.46. We're trading above the third standard deviation Bollinger Band. I don't know if you could short this stock or buy options, but I think it's a short. I would use it if you're going to short it and it's optionable. I would use a bear put spread to define your risk. I wouldn't short the common if you can even get the common, because for all I know, it gets bought out and you get your face ripped off. So that's my take. Oh, Tom, I just read the second part. Yeah, you know I wouldn't like it. RMBD seems to dilute and then do RS. I see. AAL for Pat. Uh, I mean, it's one of those situations where, God damn it. Let's clear off all of these drawings. Starting the new year fresh. All right. So it's one of those situations where you got to wait, man. You got to wait. Your downtrend channel is clear, it's defined. We're in the middle of that downtrend channel. Is this a buy? No, it is not a buy. Another way to look at it is this way. Might we be putting in a higher low versus the lows of May of 2020? Maybe, maybe. But I couldn't buy this stock here right now. I would rather it break out and pay a few dollars more for the probability of making money being a lot higher than what it is right now. I don't want to buy here and hope that it goes up. If you want to sell premium, Pat, I know you sell premium. You may want to look to sell. I don't know what kind of premium you're going to get on this, what the implied volatility is, but look to sell the 10 strike, reduce your basis cost. It's one way of playing it, but I don't know what the premiums are like. So it's probably cheap premiums because it hasn't done much anyway. So I'm kind of indecisive about it. Now, the weekly chart looks kind of interesting. Possible higher low versus September. You want to put a swing trade on? Fine. Use a stop right below the October 3rd lows or the week of the October 3rd lows. And that's what I would do. All right, last one. Cal-Maine. Cal-Maine reported last week. I took a look at their IBD, Investors Business Daily rankings. Pretty goddamn good. Really, really good. So I think that this is a buying opportunity. You need to respect the fact that Cal-Maine is a very, very volatile stock, very thinly traded. So on the month, big outside reversal bar. I hope they push it lower. I'll buy more. Egg prices are going through the roof. I don't think it's the best managed company. Now, if I said month before, I meant week, outside reversal week, daily chart. No new daily lower low. I don't know why this keeps populating on me here. I got to get rid of this. All right, I'll deal with it later. Here it is. All right, I'll deal with it later. No new lower low. Looks like we may have paused here with the sell-off. So let's wait, allow it to consolidate, nibble, 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 wait for a setup to present itself, then add on a breakout on Cal-Maine Foods. Otherwise, I think it's probably going up higher. It's just going to take time to work off. Whatever disappointment was in those earnings, I didn't read them, but according to Investors Business Daily, the fundamentals are very, very strong. Their EPS growth is like 326%. So pretty huge. With that, folks, everybody, Happy New Year. Look forward to chatting with you for the rest of the year. Like, subscribe. 14-day free trial offer here. If you want TrendSpider, you get it free as a silver and gold level member. If you just want TrendSpider, 35% discount code, link below. Thanks for being here. Everybody have an awesome, awesome, profitable trading week and year. Be well.